Welcome to IMD Corporate. This is a program dedicated for global businesses and individuals navigating today's complex business landscape. I am Adriana Balmus, and in this series we'll explore critical legal foundations for your business journey. Each episode I will be joined by Olexandr Kyrychenko, partner with IMD Corporate and an expert in international corporate and commercial law, offering insights that bridge practical business needs with legal precision. Welcome, Olexandr.
Thank you, Adriana.
In this 6-part series, we'll take you through essential topics every business owner should understand, beginning with a key decision that will shape your business future, choosing the right business structure.
Thank you. Yes, it is important to ensure that the business is established and ran correctly from the legal and regulatory perspective from day one to avoid any unwanted surprises down the line.
So let's dive into the structure.
Okay. Well, let's start with the simplest form of business. And the simplest form of business is that of sole trader. What is a sole trader? Sole trader is essentially an unincorporated business where the owner and the business are legally the same entity. The unincorporated business cannot have its own legal entity or its own legal rights to, for example, enter into any contracts. Now, whilst it's easy to set up and the owner will have full control of the business with a minimum regulatory requirements, there are some risks. As touched upon, the risks are the unlimited personal liability because the business is not its own legal entity. Therefore, any contracts that are entered into in the name of the business owner. And what this means is that if the business fails, the business owner's personal assets will be at risk. From a tax perspective, any income will be taxed as personal income, what goes to income tax and national insurance contributions. Now, similarly, where two or more people wish to get into a business and once again wish to keep the regulatory requirements to a minimum, they could enter into an unincorporated partnership. Now, this is as simplest form of business for two or more people, where the individuals and the business are once again legally the same entity, as an unincorporated partnership that does not have its own legal identity. Now, once again, whilst it's easy to set up, there are risks. Notwithstanding the fact that there is a shared risk between the owners, it is likely that any commercial agreements will involve the owners entering into these commercial agreements with third parties jointly. And whilst they will share the risk between themselves, it is not possible to it's not possible to apportion the risks between the owners when against the third party, only amongst themselves, which they can do in a partnership agreement. And whilst the partnership agreement itself is not a requirement, it is recommended. Now, with tax implications, once again, income is taxed as personal income.
Are there business structures that would go further in protecting the business owner's personal assets?
Yes, there are a number of structures. And whilst we were on the subject of partnerships, partners can enter into what's known as a limited liability partnership. Now, an LLB provides a greater protection to partners. It is a legal entity with unlimited capacity to enter into its own contracts and is separate from the partners themselves. Now, whilst it is more complicated to establish than a simple partnership, as it requires an LLP agreement and registration with a company's house, the liability of each partner will be limited to the amount invested. and its structure is flexible, similar to a partnership. Now, LLPs are usually found in professional services such as accountancy firms and law firms. Now, with the LLP being a separate legal entity, the partners will be subject to a number of regulatory requirements, which they must comply with. If they fail to do so, their personal assets could be threatened. As such, if you choose to set up an LLP, you have to be fully versed with the legislation that affects the running of it and your personal responsibilities as a member of an LLP, including the fiduciary duties to the LLP and its creditors. Turning to taxation, each partner's share on profits will be taxed as income tax. However, as this partnership is an LLP, there will be additional reporting requirements.
If you mostly find this business structure within professional businesses, what business structure would be more common in a wider landscape?
That's a good question. The most common business structure that also offers protection would be that of a private limited company or an LTD. Now, a private limited company is a separate legal entity. It's distinct from its owners, and the ownership of the company is divided into shares, which are held by the owners. There are no restrictions on the number of shares that can be issued by a company, and a company can issue different types and classes of shares. The liability of each shareholder would be limited to the nominal value of the shares, or sometimes the share premium that they had to pay. However, it's usually paid up on allotment, and there is no outstanding liability of the shareholders to the business, thus no additional personal risk. In addition, it is easier to raise capital when dealing with a private limited company, whether this is done through issuance of new shares to current owners or via issue of preference or other types of shares to investors. The flexibility of the structure allows for different classes of shares, each for their own voting rights, and other rights such as rights to dividends and rights to purchases of shares of outgoing shareholders. The governance structure of the company is usually set out in the Articles of Association, which are usually extensively negotiated when investors come on board. And these Articles of Association are public. In addition, the shareholders will enter into a shareholders agreement, or should enter into a shareholder agreement. Whilst it is not a requirement, it is highly advised. Now, shareholders agreement itself will not be public. Now, turning to risks, the shareholders will often also be directors of the company, and as such, they will have fiduciary and other duties to the company, its creditors, and its members. Now, these duties are set out in the Companies Act, and if the directors breach their duties, or if they breach the Articles of Association, i.e. the governance documents for the company, they could find themselves personally liable for losses of the company. It's important to note that this can also extend to shareholders who are not necessarily statutory directors, but nonetheless exercise control over management of the company. In such instances, they could be deemed as de facto directors, and where this occurs, such personal liability could be extended to them. Now, turning to tax side of things, the company will pay corporation tax on its profits, and there could be a particular benefit where a company is part of a group with more than one, let's say, startup company in the group, or with a holding company. And this is because where one company makes a loss in a tax year, it can be often offset against profits of other companies in the group, thus reducing the overall tax burden. each shareholder will usually receive dividends and will pay dividend tax on the dividends received. However, dividend tax rates are often lower than income tax rates.
As we come to the end of this episode, what would be the best structure for a new business venture?
That's a good question. However, the answer depends on your business and your plans. And there are a number of factors you should consider when choosing the business structure, such as how your choice of structure can support or hinder future expansion and growth. Which structures are most appealing to investors? The importance of protecting your personal assets. How important is the tax liability to you? Often that is the most important aspect. And how far are you willing to go in order to balance the simplicity of running your business with the legal protection and expense at a cost and administrative burden? It's important to bear in mind that you will not be beholden to the business structure that you chose at the outset for the life cycle of your business. And you can change your business structure as your business grows. Having said this, I would strongly suggest that you seek legal and tax advice when establishing your business, as the right structure can be critical to early and medium success. Now, just to quickly summarize, different structures offer varying levels of personal liability, ranging from limited companies and LLPs, which separate personal assets from business assets, in contrast to sole traders and partnerships, whereby the owner's assets are always at risk if the business runs into difficulties. Different business structures determine how your income will be taxed. Sole traders and partners pay income tax, whilst limited companies pay corporation tax and provide opportunities to offset against profits made by other members of the group. Choosing the most tax-efficient structure can reduce the overall tax burden on the business and its owners. It is also important to bear in mind what type of structure is more attractive to investors. For example, private limited companies are far more attractive because they offer shares in the company and have clear legal frameworks and the ability to raise capital. How much control and management you would like to have over your business is also important. It's in particular where investors have come into your business. Often, investors, including angel investors and private equity firms, will have a substantial element of control over day-to-day management and in particular over critical decisions in the business. Now, it is obviously important to have investment come into the company, and it should be balanced against the control that you're willing to give up. Which brings me on to the growth of your business and the potential growth of your business, whether you choose to grow organically or more aggressively. And the business structure that you chose can have a substantial effect on this aspect.
So, choosing the right business structure is a foundational decision that influences many aspects of your business operation, growth, and success.
Yes, that is correct. And whilst some structures, like sole proprietors, are easier and cheaper to set up than limited companies, the right structure balances setup costs with the benefits that it provides. In our experience, the most common solution is that of a private limited company. As such, in the rest of this podcast, we will focus on this particular business structure.
Thank you, Olexandr, for all this valuable information. And to our audience, thank you for watching us. This episode will be in our IMD corporate series. We hope this discussion had shed light on the importance of selecting the right business structure for your unique needs. In our next episode, we'll delve into essential legal documents that every private limited company should have to establish a strong legal foundation. Thank you, and we'll see you in the next video.